Welcome to the UK SME Tax and Business Guide, a comprehensive training course brought to you by Reinza Limited. This course covers everything you need to know about UK taxation as a small or medium business owner. We will walk through the entire UK tax system step by step, from choosing your business structure through to income tax, national insurance, corporation tax, VAT, capital gains tax, and much more. All the rates and thresholds in this course are current as of February 2026, and we have included all confirmed changes coming into effect in April 2026 and beyond. Whether you are a sole trader, a company director, or thinking about starting a business, this course will give you the knowledge you need to manage your taxes with confidence. Let us get started. This course contains 14 chapters and will take approximately 6 to 8 hours to complete. It covers the 2025 to 2026 and 2026 to 2027 tax years. Access is completely free. Here is what you will learn. We will cover the structure of the UK tax system, how to choose the right business structure, the main taxes that affect UK businesses, including income tax, national insurance, corporation tax, VAT, and capital gains tax. We will also look at the PAYE system and employer obligations, making tax digital requirements, allowable expenses and record keeping, key dates and deadlines along with their penalties, legitimate tax planning strategies, capital allowances, and a full timeline of upcoming changes through to 2029. Before we begin, an important note. This course is for general information and training purposes only. It does not constitute professional tax advice. All rates and thresholds are current as of February 2026, including confirmed April 2026 changes. You should always consult a qualified accountant for advice specific to your circumstances. Chapter 1. The UK Tax System. An Overview. In this chapter, we will lay the foundation by understanding how the UK tax system is organised. We will look at which government bodies are responsible for tax collection and company regulation, how the tax year works, and the fundamental calculation that sits behind all UK taxation. This is essential knowledge before we get into the specific taxes. There are two key government bodies you need to know about. The first is HMRC, which stands for His Majesty's Revenue and Customs. This is the UK's tax authority. HMRC is responsible for collecting all taxes, including income tax, corporation tax, VAT, and national insurance. Every business in the UK must deal with HMRC. The second is Companies House. This is the official registrar of UK companies. If you operate a limited company, you must file annual returns and accounts with Companies House. The register is public, meaning anyone can search and view your company information. Here is an important distinction. If you are a sole trader, you only need to deal with HMRC. But if you operate a limited company, you must deal with both HMRC and Companies House. That means more filing obligations and more deadlines to track. Now, the tax year. For individuals, the personal tax year runs from the 6th of April to the 5th of April the following year. This applies to income tax, national insurance, and capital gains tax. For companies, the financial year runs from the 1st of April to the 31st of March, and this is used for corporation tax purposes. These two periods are close but not identical, so it is important to be aware of which one applies to your situation. Let us now look at the 5 main taxes that affect UK businesses. First, income tax. This is paid by individuals on their personal income, including salary, self-employment profits, rental income, and dividends. Second, national insurance. These are contributions paid by employees, employers, and the self-employed. They fund the state pension and certain benefits. Third, corporation tax. This is paid by limited companies on their profits. The rate ranges from 19% to 25%, depending on profit levels. Fourth, VAT, or Value Added Tax. This is a consumption tax charged on most goods and services at a standard rate of 20%. And fifth, capital gains tax. This is paid by individuals on the profit made when selling assets that have increased in value. Current rates are 18% for basic rate taxpayers and 24% for higher rate taxpayers. At its core, the basic formula behind all UK taxation is quite simple. You take your income, subtract your allowable deductions, and that gives you your taxable income. You then multiply that by the relevant tax rate to arrive at the tax due. The challenge, of course, is in the details, and that is what the rest of this course will cover. Chapter 2. Choosing your business structure. This is one of the first and most important decisions you will make. Your chosen structure determines how much tax you pay, how much administration you deal with, and what legal protections you have. We will compare the 2 most common structures for UK SMEs: sole trader and limited company. Let us compare the 2 main options side by side, starting with the sole trader. This is the simplest structure. It is free to set up. You just register with HMRC for self-assessment. There is minimal administration, no requirement to file formal accounts. You keep all the profits, and your financial information stays private. However, there are downsides. As a sole trader, you have unlimited personal liability. That means, if your business runs into debt, your personal assets are at risk. You may also pay higher tax once your profits grow beyond a certain level, and it can be harder to sell or transfer the business. Now, the limited company. A limited company is a separate legal entity. Your personal assets are protected by limited liability. It is generally more tax efficient once your profits are consistently above around £50,000. You have flexible remuneration options, meaning you can pay yourself through a combination of salary, dividends, and pension contributions. And a limited company tends to project a more professional image, which can help when raising finance. The downsides: higher setup and ongoing costs, more administration, including preparing formal accounts, filing a corporation tax return, and running PAYE. And you will usually need an accountant, which typically costs between £800 and £2,500 per year. So how do you choose? Here is a quick decision guide. If you are just starting out and your income is uncertain, go with sole trader. It costs nothing and keeps things simple. If your annual profits are below £30,000, sole trader is also the better option. The tax difference at this level is minimal, and the extra costs of running a limited company would eat into any savings. If your profits are consistently above £50,000, a limited company becomes significantly more tax efficient. The savings from the lower corporation tax rate and dividend strategy can be substantial. If your business carries meaningful legal risk, a limited company protects your personal assets through limited liability. And if you are going into business with others, you should consider a partnership or a limited liability partnership. Let me give you a worked example. Sarah earns £45,000 freelancing, with £10,000 in allowable expenses. Her taxable profit is £35,000. As a sole trader, her income tax comes to approximately £4,486. Her Class 4 national insurance is around £1,346, and her Class 2 national insurance is £182. Her total tax bill is approximately £6,014, giving her an effective tax rate of around 17.2%. One final tip: review your structure annually. It is very common and perfectly sensible to start as a sole trader and incorporate as a limited company later once your profits grow. Chapter 3: Income Tax. Income tax is the most fundamental UK tax. It applies to all individuals on their salary, self-employment profits, rental income, savings interest, and dividends. Understanding the tax bands and rates is essential for every business owner. Let us look at the current income tax bands, which apply for both 2025 to 2026 and 2026 to 2027. The personal allowance is the amount you can earn completely tax-free. It is £12,570. This means the first £12,570 of your income is not taxed at all. The basic rate band covers income from £12,571 up to £50,270. This is taxed at 20%. The higher rate band covers income from £50,271 up to £125,140. This is taxed at 40%, and the additional rate applies to income above £125,140, taxed at 45%. These thresholds are frozen until 2030 to 31. That means as wages rise over time, more people are being pulled into higher tax bands. This effect is known as fiscal drag. Now, there is a critical trap that catches many people: the £100,000 personal allowance trap. For every £2 you earn above £100,000, your personal allowance is reduced by £1. By the time your income reaches £125,140, your entire personal allowance has been eliminated. The result? Your effective marginal tax rate on income between £100,000 and £125,000 is 60%. That is higher than even the 45% additional rate. This is a very common and painful surprise. The strategy? Pension contributions can bring your income back below £100,000 and restore your full personal allowance. We will cover this in more detail in the tax planning chapter. Dividends have their own separate tax rates, and there are important changes coming in April 2026. Currently, in 2025 to 2026, the dividend allowance is £500 tax-free. The basic rate on dividends is 8.75%. The higher rate is 33.75%. And the additional rate is 39.35%. From April 2026, the 2026 to 2027 tax year, the basic rate increases by 2 percentage points to 10.75%. The higher rate also increases by 2 percentage points to 35.75%. The additional rate and the dividend allowance remain unchanged. This is a significant change for limited company directors who use the low salary plus dividends strategy. The 2% increase may not sound like much, but on a dividend income of, say, £40,000, that is an extra £800 in tax per year. Action required. If you are a limited company director, you should review your remuneration plan with your accountant before the new tax year begins in April 2026. There may be opportunities to bring forward dividend payments or adjust your salary and pension strategy. Chapter 4. National Insurance Contributions. National insurance is separate from income tax, although it is often collected alongside it. NIC's fund the state pension, statutory sick pay, maternity allowance, and other state benefits. There are several different classes of national insurance, and which ones you pay depends on whether you are employed, self-employed, or an employer. Let me walk you through the main classes for 2025 to 2026. Class 1 employee contributions are paid by employees. The rate is 8% on earnings between £12,570 and £50,270, and 2% on anything above that. These are deducted automatically through PAYE. Class 1 employer contributions are paid by employers on top of wages. From April 2025, the rate is 15% on earnings above £5,000. This is a significant cost that many new employers underestimate. Class 2 is paid by the self-employed. It is a flat rate of £3.50 per week, which works out to roughly £182 per year. This is important for building your state pension record. Class 4 is also paid by the self-employed. The rate is 6% on profits between £12,570 and £50,270, and 2% above that. This is collected through your self-assessment tax return. Class 3 is voluntary. At £17.75 per week, it allows you to fill gaps in your national insurance record to ensure you qualify for the full state pension. And here is an important tip. You need 35 qualifying years of national insurance to receive the full state pension. You can check your current record online at gov.uk/check-national-insurance-record. I strongly recommend doing this, especially if you have had gaps in employment or have worked abroad. Chapter 5. The PAYE system and employer obligations. If you employ anyone, including paying yourself a salary as a company director, you must understand PAYE. PAY stands for Pay As You Earn. It is the system through which employers deduct income tax and national insurance from wages before paying the employee. There have been major changes to employer national insurance from April 2025. Let me highlight the 3 key changes. First, the employer NI rate has increased from 13.8% to 15%. Second, the secondary threshold, which is the point at which employer NI starts has been reduced from £9,100 per year down to just £5,000 per year. And third, the employment allowance has been increased from £5,000 to £10,500, and the previous upper limit on NI bills has been removed entirely. These first two changes mean employers are paying more NI. But the increased employment allowance of £10,500 helps offset this for many small businesses. However, there is an important caveat. If the company's only employee is the director and there are no other staff, the company cannot claim the employment allowance. This catches a lot of single director companies. On the right of this slide, you can see the national living wage rates. From April 2026, the rate for workers aged 21 and over increases to £12.71 per hour. Finally, here is the employer PAYE compliance checklist. Step 1. Register for PAYE before your first employee's payday. Step 2. Deduct income tax and employee NI from each payment. Step 3. Calculate employer NI on top of wages. Step 4. Submit a full payment submission to HMRC through real-time information each pay date. Step 5. Pay total deductions to HMRC monthly or quarterly. And Step 6. Issue a P60 to each employee at the end of the tax year. Chapter 6. Corporation Tax. Corporation tax is the tax paid by limited companies on their profits. It is entirely separate from the directors' or shareholders' personal taxes. Understanding corporation tax rates and how to efficiently extract profits from your company is crucial for every limited company director. Corporation tax has a two-tier rate structure with marginal relief in between. For profits up to £50,000, the small profits rate of 19% applies. This is the rate most small companies will pay. For profits between £50,000 and £1 and £250,000, marginal relief applies. The effective rate gradually increases from 19% towards 25%. In practice, each additional pound of profit in this band is taxed at approximately 26.5%. For profits above £250,000, the main rate of 25% applies. Now, how do you get money out of your company? There are 4 main methods. First, salary. This is deductible for corporation tax, meaning it reduces your company's taxable profit. However, you will pay income tax and national insurance on the salary. Second, dividends. These are paid from after-tax profits. Dividend tax rates are lower than salary rates, and there is no national insurance on dividends. However, dividends are not a corporation tax deduction. Third, pension contributions made by the company. These are fully deductible for corporation tax and are completely free of national insurance. The downside is that the money is locked away until you reach pension age. And fourth, expense reimbursement. If you incur genuine business expenses personally, the company can reimburse you tax-free. But they must be real business expenses, with proper receipts. The optimal strategy is usually a combination of all 4, and we will discuss this further in the tax planning chapter. Chapter 7. Value Added Tax, commonly known as VAT. VAT is a consumption tax charged on most goods and services in the UK. Businesses collect VAT from their customers and pay it to HMRC after deducting any VAT they have paid on their own business purchases. This difference is what you actually pay to or reclaim from HMRC. There are 4 VAT rates you need to know. Standard rate is 20%. This applies to most goods and services. Reduced rate is 5%, applying to things like domestic energy and children's car seats. Zero rate is 0%, applying to most food, children's clothing, and books. And some supplies are exempt, meaning VAT does not apply at all. Examples include financial services, insurance, and education. Now, here is a crucial distinction that many people get wrong. Zero-rated and exempt are not the same thing. Zero-rated supplies are within the VAT system. You charge 0% VAT, but you can still reclaim the VAT on your business purchases related to those supplies. Exempt supplies are outside the VAT system entirely. You do not charge VAT, but you also cannot reclaim the VAT on purchases related to those supplies. This distinction can have a significant financial impact. Registration. You must register for VAT if your taxable turnover exceeds £90,000 in any rolling 12-month period. You can also register voluntarily at any turnover level, which is often beneficial if most of your customers are VAT-registered businesses, because they can reclaim the VAT you charge them. Deregistration is available if your turnover drops below £88,000. There are also 3 helpful schemes for small businesses. The flat rate scheme lets you pay a fixed percentage of your gross turnover, simplifying your VAT accounting. This is available for businesses with turnover up to £150,000. Cash accounting means you account for VAT when money is actually received or paid, rather than when invoices are issued. And annual accounting means you submit just 1 VAT return per year instead of 4, with regular payments spread throughout the year. Chapter 8. Capital Gains. Tax, or CGT. Capital gains tax is the tax you pay on the profit when you sell or dispose of an asset that has increased in value. This could be a buy-to-let property, shares, a business, or other valuable assets. Your main home is normally exempt. For 2025 to 2026 and 2026 to 2027, CGT rates have been unified at 18% for basic rate taxpayers and 24% for higher and additional rate taxpayers. The annual exempt amount is £3,000, meaning the first £3,000 of gains each year are tax-free. Now, there is a special relief called Business Asset Disposal Relief, or BADR. This provides a reduced CGT rate when you sell your business or qualifying shares up to a lifetime limit of £1 million. The BADR rate has been changing. In 2024 to 2025, it was 10%. In 2025 to 2026, it increased to 14%. And from April 2026, it increases again to 18%. The timing matters enormously here. On £1 million of qualifying gains, the difference between 14% and 18% is £40,000 in extra tax. If you are considering selling your business or qualifying shares, you should seek professional advice before April 2026 to understand whether accelerating the disposal could save you a significant amount. One more tip: your main home, known as your principal private residence, is normally completely exempt from CGT under private residence relief. However, partial charges may apply if part of your home has been used exclusively for business, or if you have let out part of it. Chapter 9. Making Tax Digital, often abbreviated as MTD. This is HMRC's program to modernize the UK tax system. It requires businesses to keep digital records and submit tax information to HMRC more frequently using compatible software. This is a significant change from the traditional annual self-assessment return. Let me walk you through the implementation timeline. MTD for VAT has been in effect since April 2019. If you are VAT registered, you should already be complying with this. The big change is MTD for income tax self-assessment, which launches in April 2026. This initially applies to self-employed individuals and landlords with income above £50,000. From April 2027, the threshold drops to income above £30,000. And from April 2028, it drops further to income above £20,000. Under MTD, instead of filing one annual tax return, you must submit 4 quarterly updates plus 1 end-of-period statement using MTD-compatible software. The quarterly deadlines are as follows. Quarter 1 covers the 6th of April to the 5th of July, with a submission deadline of the 7th of August. Quarter 2 covers the 6th of July to the 5th of October, due by the 7th of November. Quarter 3 covers the 6th of October to the 5th of January, due by the 7th of February. And Quarter 4 covers the 6th of January to the 5th of April, due by the 7th of May. The final declaration for the full year remains due by the 31st of January. There is some good news. HMRC has confirmed that late filing penalties will not be imposed for quarterly updates during the 2026 to 2027 tax year, which is the first year. The full penalty regime takes effect from April 2027. This gives you a grace period to get used to the new system. However, an important note: these quarterly updates are for information only. They do not change your tax payment dates. You still pay your tax on the 31st of January, as before. Chapter 10. Allowable expenses and record keeping. Getting your expenses right is crucial. Every legitimate business expense you claim reduces your taxable profit, which directly reduces your tax bill. But you must understand what is and is not deductible. And you must keep proper records. Let me run through the most common expenses and whether they are deductible. Premises rent is deductible for both sole traders and limited companies. If you work from home, only the proportion used for business can be claimed. Vehicle costs are handled through mileage allowances. You can claim 45 pence per mile for the first 10,000 miles and 25 pence per mile thereafter. Accountancy fees are fully deductible for both sole traders and limited companies. Director's salary is an interesting one. For a limited company, yes, it is a deductible expense. But for a sole trader, no. Your profit already is your income, so there is no salary to deduct. Client entertainment is never deductible, regardless of your business structure. This is one of the most commonly misunderstood rules. For working from home, you have 2 options. The simplified method gives you a flat rate of £6 per week, totaling £312 per year. No receipts are needed. The actual cost method involves calculating the precise business proportion of your household costs. This typically gives a higher deduction but requires detailed records. Now, the top 3 triggers for an HMRC investigation. Number 1. Mixing personal and business expenses. Number 2. Missing invoices or receipts. And number 3. Unreported cash income. Avoid these at all costs. Essential record-keeping rules. Separate your business and personal bank accounts. Keep evidence for every single transaction, including invoices, receipts, and bank statements. Retain all records for at least 6 years. And record transactions promptly. With Making Tax Digital requiring quarterly submissions, real-time bookkeeping becomes essential. Chapter 11. Key dates and deadlines. Missing a tax deadline means automatic penalties. There are no excuses accepted for simply forgetting. So it is essential that you know every key date and put them in your calendar immediately. For self-assessment, the key dates are as follows. The 6th of April is when the new tax year begins. The 5th of October is the deadline to register for self-assessment if you are newly self-employed. The 31st of October is the paper return filing deadline. The 31st of January is the critical date. This is the online filing deadline, the payment deadline for any tax owed, and the due date for your first payment on account. The 31st of July is when the second payment on account is due. For limited companies, deadlines are calculated from your financial year end. 9 months and 1 day after your year end, your corporation tax payment is due. 9 months after your year end, your accounts must be filed with Companies House. 12 months after your year end, your CT 600 return must be filed with HMRC. And, within 14 days of your company's anniversary date, you must file a confirmation statement with Companies House, which costs £50. Now, the penalties. These are severe and automatic. For self-assessment, filing just 1 day late incurs an immediate £100 penalty. After 3 months, you face daily penalties of £10 per day, up to a maximum of £900. After 6 months, an additional 5% of the tax due is charged, with a minimum of £300. And after 12 months, another 5% is added. For corporation tax, the penalties are similar. £100 for the first day late, another £100 at 3 months. At 6 months, 10% of unpaid tax. And at 12 months, a further 10%. These penalties can add up very quickly, and they apply even if you do not actually owe any tax. Do not miss your deadlines. Chapter 12. Legitimate tax planning strategies. Tax planning is about arranging your financial affairs to minimize your tax liability within the rules. It is entirely legal and is fundamentally different from tax evasion, which is a criminal offense. Every business owner should be taking advantage of the legitimate planning opportunities available to them. The first principle is to use all available allowances. Many people leave money on the table by not fully utilizing these. The personal allowance gives you £12,570 of tax-free income. The dividend allowance gives you £500 of tax-free dividends. The trading allowance means side income below £1,000 does not need to be declared. The ITSA allowance of £20,000 means all income and gains within an ITSA are completely tax-free, and the CGT exempt amount of £3,000 per year should be used by spreading asset disposals across tax years where possible. Pensions are one of the most powerful tax planning tools available. For personal contributions, you pay £80 and the government adds £20 through tax relief. That is an immediate 25% return on your money. For higher rate taxpayers, you can claim further relief through your tax return. For company contributions, the employer pension contribution is fully deductible for corporation tax and is completely free of national insurance. This makes it one of the most tax-efficient ways to extract profits from your company. The annual pension allowance is £60,000, and you can carry forward any unused allowance from the previous 3 years. However, be aware of upcoming changes. From April 2027, pensions will be included in the scope of inheritance tax. And from April 2029, salary sacrifice pension contributions above £2,000 per year will become subject to national insurance. Finally, the classic director remuneration strategy. Step 1. Set your salary at around £12,570, which is the personal allowance level. This avoids income tax and employee national insurance. Step 2. Take additional profits as dividends, which benefit from lower tax rates and no national insurance. Step 3. Top up with employer pension contributions, which are corporation tax deductible and NI-free. And Step 4. Review this annually with your accountant, especially in light of the April 2026 dividend tax increase. Chapter 13. Capital allowances. When your business buys equipment, machinery, vehicles, or other capital assets, you cannot simply deduct the full cost as an expense in the year of purchase. Instead, you claim capital allowances, which spread the tax relief over time, or, in some cases, provide the full deduction up front. There are 5 main types of capital allowances you should know about. First, the Annual Investment Allowance, or AIA. This gives you a 100% deduction on qualifying plant and machinery, up to £1 million per year. For the vast majority of SMEs, the AIA will cover all your capital purchases, giving you full tax relief in the year of purchase. Second, full expensing. This is available to limited companies only. It provides a 100% first-year deduction on qualifying new plant and machinery. This was made permanent from April 2023. Third, the new 40% first-year allowance, which was introduced from January 2026. This is specifically for unincorporated businesses, meaning sole traders and partnerships, as well as leasing businesses on main rate assets. Fourth, the writing down allowance. This is used for assets that are not covered by the AIA or full expensing. The main rate is currently 18%, but it will reduce to 14% from April 2026. The special rate remains at 6%. The reduction from 18 to 14% means tax relief on these assets will be spread over a longer period. And fifth, zero-emission vehicles and electric vehicle charge points continue to qualify for a 100% first-year allowance, which has been extended until March or April 2027, depending on your accounting period. The key takeaway is that most SMEs should be able to get full tax relief on their capital purchases in the year of purchase, thanks to the generous AIA limit of £1 million. Chapter 14. Timeline of upcoming tax changes. In this final chapter, we bring together all the confirmed changes affecting UK SMEs from 2025 through to 2029. This timeline is essential for forward planning. I recommend keeping a copy and reviewing it regularly. Let me walk through the key changes chronologically. April 2025. Already in effect. Employer NI increased to 15%. The secondary threshold dropped to £5,000. The employment allowance increased to £10,500. CGT rates were unified at 18 and 24%. Business asset disposal relief rate became 14%. And the national living wage went up to £12.21. January 2026. The new 40% first-year allowance for plant and machinery came into effect. February 2026. Companies' house fees increased. Incorporation now costs £100 and the confirmation statement costs £50. April 2026. This is the big one. Making Tax Digital for Income Tax Self-Assessment launches for those with income above £50,000. Dividend tax rates increase by 2 percentage points. Business asset disposal relief goes up to 18%. The writing down allowance main rate drops from 18 to 14%. The national living wage rises to £12.71. And corporation tax, late filing penalties double. April 2027. The MTD threshold drops to income above £30,000. A 2 percentage point increase applies to tax on property and savings income. The cash ISA limit for under 65s is reduced to £12,000, and pensions come within the scope of inheritance tax. April 2028. The MTD threshold drops further to income above £20,000. And April 2029, salary sacrifice pension contributions above £2,000 per year become subject to national insurance. Keep this timeline handy and discuss it with your accountant during your annual review. Let me address some of the most common questions we receive. Question 1. I am just starting out. What should I do first? Start by choosing your business structure. For most people starting out, sole trader is the simplest option. Register with HMRC for self-assessment. Open a separate business bank account and start keeping records from day one. Question 2. Do I need an accountant? If you are a simple sole trader earning under £30,000, you may be able to manage on your own with accounting software. But if you are running a limited company or earning above £50,000, I strongly recommend having an accountant. Their fees typically save you more than they cost through tax efficiency and avoiding mistakes. Question 3. Do I have to declare cash income? Absolutely. All income, including cash, must be declared. Tax evasion is a criminal offence. HMRC has sophisticated methods for detecting undeclared income, and the penalties range from 30 to 100% of the underpaid tax, plus possible criminal prosecution. Question 4. What if I cannot pay my tax on time? Contact HMRC proactively and ask for a time-to-pay arrangement. This allows you to pay in monthly installments over 6 to 12 months. This is far better than simply missing the deadline and facing automatic penalties and interest. Here is a practical year-end checklist. Before the 5th of April each year, work through these 7 steps. Step 1. Confirm that all available allowances and reliefs have been fully utilised. Step 2. Review your pension contributions and consider making additional top-ups before the 5th of April. Step 3. Maximise your ITSA contributions for the year. The limit is £20,000. Step 4. Consider whether any capital gains tax disposals should be timed before or after the year end to make best use of your annual exempt amount. Step 5. Ensure all allowable business expenses have been recorded and supported with evidence. Step 6. Discuss next year's salary and dividend strategy with your accountant, particularly if the dividend tax rates are changing. And Step 7. Assess whether your current business structure remains the most tax-efficient option. If your profits have grown significantly, it may be time to consider incorporating. Let me summarize the key takeaways from this entire course. First, choose the right business structure and review it annually as your business grows. Second, understand which taxes apply to you: income tax, national insurance, corporation tax, VAT, and capital gains tax. Third, the April 2026 dividend tax increase requires immediate remuneration planning for limited company directors. Fourth, Making Tax Digital for Income Tax Self-Assessment launches in April 2026. Start preparing your digital record keeping now. Fifth, use all available allowances: personal allowance, ITSA, dividend allowance, CGT exempt amount, and pension contributions. Sixth, pensions are one of the most powerful and flexible tax planning tools available. Make sure you are using them effectively. Seventh, never miss a deadline. Penalties are automatic and can be substantial. And eighth, always consult a qualified accountant for advice specific to your circumstances. This course gives you the knowledge to have informed conversations with your accountant, but it is not a substitute for personalised professional advice. We have a number of resources available to help you further. You can download the complete UK SME Tax and Business Guide, it covering all 14 chapters with worked examples and tax tables. We also have a video tutorial on our YouTube channel with a comprehensive walkthrough of UK SME taxation fundamentals. For official government resources, the following websites are particularly useful: gov.uk/register for self-assessment for registering with HMRC, gov.uk/check national insurance record for checking your NI history, gov.uk/government/organisations/companies house for companies house services, and gov.uk/making tax digital for the latest MTD guidance and software lists. Thank you for completing the UK SME Tax and Business Guide training course. I hope this course has given you a solid foundation for understanding UK taxation as a business owner. Remember, the key to managing your taxes well is staying informed, keeping good records, and planning ahead. If you need professional help with your accounts, tax returns, or tax planning, the team at Reinza Limited is here to help. You can reach us at contact@reinza.com or visit our website at www.reinza.com. Thank you for watching.